Mangaluru branch of SIRC of ICAI and Mangaluru branch of SICASA of ICAI extend a warm welcome to each one of you to Knowledge Session 3, Vriddhi, Startup Ecosystem and Capital Markets as part of UDGAM National Conference of CA Students 2026. The startup ecosystem today stands as a symbol of innovation, ambition, and enterprise, while capital markets continue to play a vital role in enabling growth and investment opportunities. Together, they form an evolving landscape that holds immense relevance for chartered accountants. Today's session promises to offer meaningful insights into entrepreneurship, investments, and the financial and regulatory dimensions that shape modern businesses. To guide and moderate this insightful session, we are honored to have with us the esteemed CA Swathi Pai. I now request CA Nitin Baliga, Treasurer of Mangaluru branch of SIRC of ICAI, to kindly escort our moderator along with the paper presenters to the dais. It is my pleasure to introduce CA Swathi Pai. She is presently associated with Ventana Ventures as an investment analyst with expertise in venture capital, portfolio management, and investment analysis. She also possesses experience in APAC tax compliance, reflecting a strong understanding across financial and regulatory domains. A brilliant academic achiever, she cleared all levels of the Chartered Accountancy examinations in her very first attempt, while simultaneously pursuing her Bachelor of Commerce degree. She also secured the 4th rank in Karnataka State PO examinations and actively contributed to SICASA Mangaluru during the term 2022 and 2023, a tenure during which the branch was honored with the recognition of the 2nd best SICASA branch. Beyond her professional accomplishments, she actively mentors CA aspirants in examination strategy and career development. Ma'am, it is indeed a pleasure to have you among us today and extend to you a heartfelt welcome. I request CA Rajesh Lobo, partner at Ganesh and Sudhir Chartered Accountants, to present a token of welcome to the Session Chairperson. Thank you, sir. Among us today are talented paper presenters who are here to share their insights on various aspects of the startup ecosystem and capital markets. Our first paper presenter for the session is Mr. Madhav Lila from Chandigarh, currently pursuing his articleship at Maheshwari Kaushik and Associates. A national finalist in the ICAI Board of Studies debate competition, he has demonstrated excellence in public speaking and academic discourse. His areas of interest include the stock market, startups, and finance. It is a pleasure to welcome Mr. Madhav Lila as the first paper presenter for the session. Our second paper presenter is Mr. M. Abhijeet Kamath, currently pursuing his articleship at Prasanna Shennai & Co. Chartered Accountants, Mangaluru. An active participant in SICASA events and competitions, he has distinguished himself through multiple victories and podium finishes in quiz competitions. His keen interest in stock markets, investment, and business analysis reflects his enthusiasm for the evolving world of finance. We are delighted to welcome Mr. M. Abhijeet Kamath as the second presenter for the session. Our next paper presenter is Ms. Anisha Mallya, a CA finalist, currently undergoing her articleship at Prasanna Shennai & Associates, Mangaluru. A consistent, outstanding academic performer, she secured 2nd rank in the state of Karnataka in 2nd PUC examinations and later achieved 2nd rank in BCom examinations at St. Aloysius College, Mangaluru. Beyond academics, she enjoys reading and art, reflecting a well-rounded personality. We are pleased to welcome Ms. Anisha Mallya as a paper presenter for the session. We now come to our final paper presenter, Mr. Austin Johann Kunna, a CA finalist, serving his articleship at D'Souza Lobo Saldana. An active participant in various SICASA competitions, he has developed keen interest in public speaking alongside his academic and professional pursuits. Beyond the profession, he enjoys cricket and watching thriller series. We are delighted to welcome Mr. Austin Johann Kunna as a final paper presenter. Dear delegates, please welcome all our presenters with a warm round of applause. I request Rohit, member of Mangaluru branch of SICASA of ICI, to present a token of welcome to our paper presenters. Without further ado, let us begin with our first presentation. I invite Mr. Madhav Lila to present his paper on understanding valuation, ESOPs and CCPs in startup. The stage is yours.
So, we all have somewhere or somewhat heard that this startup's valuation crossed X trillion dollars, that startup valuation crossed Y billion dollars, and India's startup ecosystem is growing at a very high pace. Such a high pace that if we chartered accountants do not match the space with this pace, we will be far behind from reality. So here I am to talk about three most important terminologies that are being used in the startup ecosystem: valuation, ESOPs, and CCPs. A very warm good morning to one and all present here. Myself, Madhav Lila, an article assistant at Maheshwari Kaushik and Associates from Chandigarh, stand before you to present a paper on the topic, understanding valuation, ESOPs, and CCPs in startup. Firstly, valuation, a very trendy topic and often misunderstood. People think that valuation is more often include big hefty formulas and various logics and assumptions, but it is more like of an art. I will give you three reasons why. Firstly, valuation is not a measure of success. It is based on assumption of a growth of startup. Second, it is a negotiated story. It emerges from interaction of method, data, and negotiation. For example, Aman Gupta just raised 100 crore rupees as a seed funding for his new venture Offbeat, just on basis of an idea. No customer base, no supplier agreements, just an idea. Third, and the most important, VCs think about their exit first. When they value a startup, they are not valuing it what it is today. The entry price is calculated backward from their target exit. So if they expect a higher return from a startup in future, they will give a higher valuation at today so that their higher exit valuation is more feasible in future. So to calculate a valuation number on the basis of their current financials of the company, I have listed here 4 methods. Although there are many more methods that are being used in the market right now, but these are the most prominent one. First one is cost to duplicate. It values the startup based on the cost of recreating assets from scratch. Covers R&D costs, physical assets, and IPs. Second is market multiple, the most favorite method of VCs. Compares it in this method, the multiple is given to a benchmark level such as revenue or EBITDA on the basis of the industry average. Third one is discounted cash flows. I believe all the audience sitting here already know about the DCF technique. Free cash flows for the firm is calculated and discounted them to the present value using the required rate of investor. Last but not the least is valuation by stage. Used primarily by angel investors, and it is a comparatively easier method to calculate valuation. Now, here is the catch. No single method is universally correct, and many big VC firms believe in the fact that if they have to apply a valuation method for calculating valuation of a company, then that deal is not really an efficient deal. So, to understand valuation more better, we have to get the context of valuation. That is pre-money valuation or a post-money valuation. Both have a huge difference in it. So pre-money valuation is the valuation, that is valuation of the company before receiving the investment. And post-money valuation is the valuation at which the new investor is actually willing to invest in the company. The difference between the two is just the investment amount itself. So it is very important to know that which valuation is being discussed for which of the for startup, and to get the better knowledge about the startup. Now, every founder actually get very excited and happy with the high valuation, and of course, that's the point of celebration. But we have to understand the fact that the high valuation is actually imposes huge burden to the founder's shareholder. To explain this, here we have two classical case studies, WeWork and Baiju's valuation fall. WeWork valuation fell from $47 billion to just $8 billion. It was due to they failed to IPO after scrutiny over its business model and governance. And Baiju's valuation fell from $22 billion to just $0.2 billion. That's a fall of more than 95%. It was triggered by accounting irregularities and governance failures. And notable investors like BlackRock and various other investors also reduced their stake. So we have to understand the fact that high valuation actually limit their exit options. Next up, we have ESOPs, employee stock option plans, an instrument that is used by founders or organizations to actually reward their employee and provide them with a sense of ownership. So let's start with a very basic question. Why ESOPs matter? Actually, specifically in startups, why do they matter? So here are the reasons. ESOPs help in talent affordability for the startups, retention mechanism, they help to retain the employees in the organization for a longer period of time, bring ownership culture in the organization, meeting with the investors' requirement, and aligning the exit for founders as well as the investors. So now let's read the number with me. 70% of the Indian startups struggle to manage ESOPs, and Indian startup market is expected to reach $200 billion by 2027. So there is a lot of space to build a good practice upon in this startup market. Now, how does ESOP process actually works? So first and foremost is grant. Company grant options at a fixed price, typically at or below fair market value. Second is vesting. Options are vested over 4 years with a 1-year cliff. That is, in the first year, no options are actually vested, and the vesting actually starts with the second year. The company's obligation at this stage is to maintain the ESOP pool and honor vesting schedule even through funding rounds. Third is exercise. At this step, employees actually pay the exercise price to convert options to shares. Fourth is exit or a sale. This is the point at which employees actually cash their rewards. At IPO or acquisition, employees sell at market price, and at this point, the employees can actually cash their rewards. So we have to understand that each and every step in this ESOP process actually requires a chartered accountant, be it complying with income tax compliance or Companies Act compliance or any other statutory requirement. A chartered accountant is always involved. Now, a very interesting fact to show that how ESOPs is actually gaining popularity in the startup market. Here we can see a graph of median shares of holding of employees as well as the founders. And we can clearly see that founders graph is gradually decreasing and employees holding percentage is steadily increasing. And around Series C, the employees holding percentage is actually more than the founders holding percentage. So ESOPs are actually gaining very popularity among the startup. Now, employees actually faces a very big risk in the environment, in the ESOP game, that if company actually never get listed. So the companies who are actually willing to pay their employees, reward their employees, do ESOP buyback. So, here is a very big example. CoinDCX, an academy, actually did buyback for ESOPs and rewarded their employee with the ownership culture. Last but not the least is CCPS, the emerging instrument that is used by VC firms. So basically, what is CCPS? Compulsory convertible preference shares. These are the preference shares that will get converted into equity shares at a future event or a date. They carries investor protection, and the founders also get protected. So the three protections that are built into every CCPS is liquidation preference. CCPS holders actually get liquidation preference over the equity shareholders. Participation rights, CCPS actually have participation rights as much as equity shareholders have. Anti-dilution protection, very important for an investor point of view. If any down round happens after the CCPS issues, then the CCPS conversion ratios adjust in the favor of investors. So it is very much powerful from the point of view of investor. Now to explain this, we have a real life case study about how a US VC firm actually structured 40 crore rupees via CCPS and in a Bangalore based startup company. So in this CCPS term sheet, there was 1x liquidation preference. Investor recovers full 40 crore rupees before any equity shareholders in case of liquidation or wind up. CCPS holders actually have participation right, and if there was any down round, then the conversion ratio will be adjusted into their favor only. So a very confusing question that we have to think about: do ESOPs holder actually rank below CCPS holder? A big answer is yes. ESOPs holder have actually ranked below CCPS holder in 3 ways. CCPS holders have liquidation preference, CCPS holders have participation right, and equity ESOPs holder, they are ranked pari passu with other equity holders. So CCPS holders actually have a full protection, and issuing CCPS will create a win-win situation for the investor as well as for the founders. So all these 3 instruments are actually related to each other, and change in one will indirectly or indirectly affect others. So valuation sets CCPS conversion price and ESOP exercise price, and CCPS dilution will shrink the ESOP pool as well. So thank you very much. That was my time. Thank you for being such a lovely audience.
Kindly note, the time taken by Madhav Lila is 10 minutes, 2 seconds.
Thank you, Madhav, for that insightful presentation. We now move on to our second presenter, Mr. M. Abhijeet Kamath, to take us through his presentation on SME IPOs for startups, SEBI listing framework, opportunities, and compliance. Over to you.
Namaste everybody. My name is M. Abhijeet Kamath. I am an articled assistant at Prasanna Shene & Co Chartered Accountants, Mangalore. We all know how important the Indian stock market is to the economy. And a very important part of this economy is SMEs and startups. And that is why my presentation is on the topic SME IPOs for startups, SEBI listing framework, opportunities and compliance. Before we begin, a small disclaimer for you guys. This presentation is strictly educational, not a buy or sell tip for anything. Please do your own due diligence, and in case your portfolio tanks, please do not come at me, because the minimum application for an IPO is rupees 2 lakhs and my net worth is not even close to it. Now, why does this SME space exist? It is because of the tripartite funding gap. What is this? SMEs are small companies, so their cost of funds is very high because risk is high. Next, there is lack of talent retention. Why? Because they cannot pay enough to their employees. And since there is lack of corporate governance, these startups face disclosure anxieties. And that is why SME IPOs exist. BSE SME and NSE Emerge are the 2 platforms launched by BSE and NSE in the year 2012 in association with SEBI. And since then, more than 1,000 SMEs have listed on the SME exchanges. And in the past 1 year itself, more than 10,000 crores have been mobilized by these SMEs. This is a huge milestone for the Indian stock market and the economy. So what is an SME IPO? Let us understand in a simple way first. There are 2 types of IPOs or companies: main board, SME. Main board, simply put, is for larger companies, much well-to-do companies. And SMEs are for the smaller companies, less well-to-do companies. Doesn't help at all, I know. That is why we have some data in the next slides. So in the SME space, there is relaxed compliance as compared to what is there in the main board space. Then these SMEs get access to public equity through this platform while it being startup friendly. Who are the key players in the SME ecosystem? First is lead manager or merchant banker. Next, market maker. These are intermediaries who ensure that even in case of very low liquidity in the stock market, the buy and sell deals get executed on the exchange. peer-reviewed CS and CS, we all know why, and the stock exchanges, that is BSE and NSE, because where else will these companies get listed? So there are 4 pillars to the SME regulations. SEBI ICDR 2018, that is issue of capital and disclosure requirements. SEBI LODR 2015, that is listing obligation and disclosure requirements. Companies Act 2013, which is the Bhagavad Gita for every company in India, and exchange-specific bylaws, that is NSE and BSE. They themselves have bylaws put forward, which may or may not be same as what SEBI has put forward. Let us understand some limits now. So companies which have post-issue paid-up share capital, that is share capital which is paid up post-issue, excluding securities premium, after execution of ESOPs, after execution of all convertible debentures, convertible preference shares, if that post-issue paid-up share capital is up to rupees 10 crores, then that company can go for an SME IPO. Now, what about the companies that are having post-issue paid-up share capital exceeding 10 crores? Then, no worries. There is an optional clause. So in case that post-issue paid-up share capital exceeds rupees 10 crores, but it is up to rupees 25 crores, then you can still go for the SME IPO. If not, you can go for the main board IPO. Also, in main board space, the DRHP, that is draft red herring prospectus, has to be filed in both the stock exchanges, that is NSE and BSE. But in case of SME, any one stock exchange would suffice. Some financial metrics include operational EBITDA of rupees 1 crore, net worth of rupees 1 crore, net tangible assets of rupees 3 crores. And as I told at the very beginning, the minimum application for an SME IPO is rupees 2 lakhs. That is 2 lots of 1 lakh rupees each, which means generally it is reserved for the high net worth individuals of the country. Also, the issue must be 100% mandatorily underwritten, unlike what happens in the main board IPO. And the lead manager, he must specifically underwrite at least 15% of the gross issue size. And the market making concept that I spoke about, it should exist for at least 3 years since the SME IPO goes. And promoters shareholding, that is paid up share capital, it should be at least 20% post issue, and that must be locked in for a period of at least 3 years. Further, the public capital that is raised, it must be used for capital expenditure, working capital, R&D, any of these general purposes. However, it cannot be used for repayment of promoter loan or promoter group entity loan. And general corporate purpose, that is GCP, that must be strictly restricted to 15% of the gross issue size or rupees 10 crores, whichever is lower. Now, once these SMEs get listed, there are post-issue compliances. And as I told, there is relaxed compliance for these SMEs. So what are these relaxations? First, SMEs are exempt from SEBI LODR regulations 17 to 27. These regulations speak about audit committee, nomination remuneration committee, and also about the strict composition of the directors board. Next, main board companies need to report financials and shareholding patterns quarterly, that is 4 times in a year. But these SMEs, they can do that half yearly, that is only 2 times in a year. Related party transaction, this disclosure is exempt in general for SMEs, but because of an amendment brought in for the companies that are in the optional range of 10 to 25 crores, they must compulsorily disclose their related party transactions even if they are in the SME space. And in case your issue size exceeds rupees 50 crores, SEBI mandates that you must appoint a monitoring agency. What does this agency do? It will monitor whether the fund that is raised is utilized for the right purpose or not. And this limit of 50 crores, it can be lowered specifically by the stock exchanges themselves in case they find it is necessary. Now I'll talk about Innovators Growth Platform. That is IGP. It is a specialized platform provided to tech, data or biotech startups, and they provide a lot of benefits to these startups and help them raise institutional money. You can research more about this because this is a really interesting topic. Now these SMEs, once they get listed on the SME exchange, they must stay there for at least 3 years. And after this 3-year period, they can choose to shift to the main board space, provided they satisfy the conditions which are put forward by SEBI. Now let us take a real world example. E2E networks, not a buy or sell recommendation. It is a company which is into cloud infrastructure. It got listed on NSE Emerge. Keep in mind, this is a startup. And since the time it got listed, it has given a return of whopping 4,500% plus. It is a big money maker for its investors and also an inspiration for for the startup founders, because this is a story of a startup which got listed through the SME exchange and made huge money. Now, what are the strategic opportunities for startups? See, SME space acts as an alternative to high-cost bank funds or debts. It helps them get premium pricing for their shares. Because they get listed on the stock exchange, one of the most reputed stock exchanges, it helps them get organic visibility. And they can retain talent through ESOPs and can also provide an exit for their existing investors. But the main question here should be, should every startup go for an IPO? Because every startup can go for an IPO, but should they go for it should be the question. And to answer that, you must see if the companies have consistent profitability, whether their revenue growth is stable, whether their corporate governance is strong, whether they're transparent with their shareholders, whether their financial position is strong, are they having good cash, is their business model scalable, are they in a really good sector? Lot of things to be checked out. And if you tick all these in the checklist, then you can definitely think of an SME IPO. Now, what about CS? We all are CS and to be CS. So, this is a gold mine for CS. A lot of money can be made, to be honest, because CS can help in pre-issue, post-issue, both places. Every step CS can help, from financial restatements to financial restructuring, to project reports, to post-issue compliances like financial audits, various exchanges and disclosures with the stock exchange. CS can be everywhere. And that is why I'm telling this is a gold mine for the CS. So how do we conclude this? I would like to conclude this by telling SME IPO is a really good platform provided to these startups, because they can get that much needed inflection point in their journey. Because once this inflection point is received, there is no looking back for these startups. And hence, these startup founders need to seriously consider SME IPO as a really good opportunity and not hesitate because of the extreme compliances or because of SEBI. And with that, I would like to conclude my presentation. Thank you for being a really good audience. This is Abhijeet Kamath signing off.
Thank you, Abhijeet, for the wonderful presentation. We now invite our third presenter, Ms. Anisha Mallya, to present her paper on modern financing options and the key accounting considerations associated with them. The stage is yours.
Begins with an idea, but it survives only when the idea finds the right capital and the right accounting treatment. Good morning, respected dignitaries, Session Chairperson, my co-presenters, and my lovely audience. My name is Anisha Mallya, and I will be presenting on the topic Modern Financing Options and Accounting Considerations for Startups. Let me begin with a simple thought. A few decades ago, if a business needed money, the options were simple. Go to a bank, offer collateral, get a loan, and repay with interest. This worked well for businesses where value was visible and tangible. However, what happened if the most valuable asset of your business was not visible, not tangible? Startups today have code, data, algorithms, brand pull, customer traction, founder capability. These are powerful assets commercially, but extremely difficult to mortgage. This creates what I call a funding mismatch. Traditional finance asks for yesterday's security. Startups need money for tomorrow's opportunity. And that is why modern financing options have emerged. Startups today are not raising money through simple bank loans or plain equity shares. They are using a host of instruments like compulsorily convertible preference shares, convertible debentures and notes, simple agreements for future equity, venture debt, crowdfunding, etc. These are powerful assets. So why are startups moving towards modern financing instruments? The answer is simple. A startup journey is not like a train route where the track is fixed from station to station. It is more like a rocket launch. In the initial few seconds, there's uncertainty, pressure, risk. But if the launch takes off, the growth can be exponential. Traditional finance was built for stable roads. Startup finance is built for uncertain skies. Let's talk about the first instrument, compulsorily convertible preference shares. These, in simple terms, it is preference share capital which will convert into equity share capital in the future. Investors like it because it gives them preference rights today and equity upside in the future. But accounting asks a deeper question. Is it truly equity? Is this a liability? Or is it something in between? The answer to that lies in the terms. If conversion is compulsory, conversion ratio is fixed, and there's no cash obligation, then it may be classified as equity. However, if conversion ratio, that is the number of shares to be issued to the investor, is variable, or there's mandatory dividend or redemption-like obligation, then it will be classified as a liability. Accounting does not ask what the instrument is called. Accounting asks what the instrument does, and that is a test of substance over form. Next comes convertible notes and debentures. Convertible debt starts like a loan, but eventually converts into equity shares. This is especially useful in a bridge financing round, where the startups need money immediately, but the valuation is not yet ready for a full price round. From the accounting perspective, component accounting comes into play. A single instrument may contain two components: the debt component, which is the obligation to repay or service the instrument, and the equity component, which is the potential to convert into equity shares in the future. This is how accounting decodes the instrument. Now comes the most interesting instrument, simple agreement for future equity, called SAFE. The idea is straightforward. Investors give money today, but receive equity shares in the future on the happening of a triggering event. The event could be an IPO, a future price round, an acquisition, a liquidity event. SAFE is a very attractive instrument because it delays the most difficult conversation in early stage startup financing, that is valuation. But SAFE is a financial chameleon because it does not neatly fit into debt or equity. It depends on the terms of the contract. If the investor receives a fixed number of shares that is decided on day one, then it may be classified as equity. But if the investor receives variable number of shares, or the number of shares to be received by the investor depends on an underlying asset, then it will be classified as a liability or a derivative instrument. Alternative capital pathways are venture debt and crowdfunding. Venture debt is a form of debt financing for high-growth startups, usually provided by venture capital investors. Crowdfunding, on the other hand, is different. It collects money from a pool of investors in the community other than institutional investors. Accounting for crowdfunding and venture debt is relatively simple. The core principle remains the same. Now you may wonder which financing instrument fits which investor. The choice of instrument does not depend on what the startup wants to issue. It depends on the risk appetite of the investor and the stage at which the startup is raising funding. What happens when no financial instrument fits? It would mean that the startup is not yet ready for finance. It could raise money through customer advances, credit from suppliers, or even by being bootstrapped, and decide on fundraising at a later stage. Now comes the most interesting accounting principle under Indian accounting standards, which is substance over form. Ind AS 32 and Ind AS 109 prescribe that every accountant must check the economic substance of the transaction rather than the legal title, the legal name, or even what the parties casually call it. The most decisive test for classification of instruments is the fixed for fixed test. It asks, is a fixed amount of cash being exchanged for a fixed number of equity shares? If the answer is yes, then equity classification is possible. If no, then liability classification may arise. That is how accounting captures the risk of an instrument. You may be wondering why I'm talking so much about Indian accounting standards when startups may not even be covered under it. This creates a strange situation because startups raise money using global venture capital logic, but may be following simplified accounting standards. It is like driving a Formula One car on village roads. So Indian accounting standards are inevitable for the startup if they plan on going for an IPO or even raising money from global investors. Now comes to the role of a chartered accountant. In the modern startup ecosystem, a chartered accountant is no longer just a compliance professional. A chartered accountant is a financial interpreter, a person who checks the substance over form, a person whose judgment decides the startup's future. I would like to conclude with a final thought. Startups today are building the future. Investors are financing the future. But chartered accountants are responsible for faithfully representing the future. Thank you for your time and your attention. Thank you again.
Kindly note, the time taken by Anisha Mallya is 8 minutes and 46 seconds.
Thank you, Anisha, for such an informative presentation. I request Mr. Austin Johann to take us through the topic of global capital for Indian startups, covering FEMA provisions, DPIIT recognition, and FDI compliance. Over to you.
A very good morning to our session moderator, CA Swathi Pai, my fellow paper presenters, and the lovely audience gathered here today. Imagine a tech startup sitting in a tiny garage in Bengaluru, suddenly raising $5 million from a venture capitalist in Silicon Valley. How do you think the foreign currency hits the Indian bank account without raising a single red flag? Well, it's not magic. It's a sophisticated dance between law, valuation, and compliance. My name is Austin Johann, and I am a CA finalist currently pursuing my articleship at D'Souza Lobo, Saldana & Co. It is truly an honor to stand before you today at this national conference, UDGAM, to present on the topic, Global Capital for Indian Startups, FEMA, DPIIT recognition, and FDI compliance. As future CAs, we love it when our clients tell us they are raising foreign funds. We think, great, more compliance work, more audit fees. But for startups, it is a double-edged sword. If there is a mistake in the pricing, this type of share instrument, or who the investor actually is, that celebrated funding milestone can turn into a severe statutory violation overnight. Now going forward, under FEMA, non-compliance doesn't just mean a polite warning letter from RBI. We are talking about civil penalties up to 3 times the transacted amount. That is why the role of a modern CA is not just of a post-mortem auditor. We need to be front-end structural architects, bulletproofing the cap table before the money ever hits the bank. Now, for an early stage startup, securing DPIIT recognition is very important. For a startup, DPIIT recognition is like a passport to global capital. But first, as advisors, we must ensure our client meets these criteria. It must be a private limited company, partnership firm, LLP, or a cooperative society. Their annual turnover should be below 200 crores, elevated to 300 crores for deep tech startups. It must be recognized as a startup for up to 10 years from incorporation, doubled up to 20 years for deep tech startups. And finally, they must focus on innovation and wealth creation, and cannot just be formed by splitting up an existing business. Historically, the DPIIT tag was used as the only shield against the notorious angel tax. Even though Budget 2024 completely abolished the angel tax for everyone, the DPIIT recognition still remains a massive asset. Why? Because it provides us with these immediate superpowers. critical income tax exemptions, a 80% rebate on patent filings, a waiver of past track records to win government tenders, and freedom from inspections via labor law self-certification. Now, once the startup is ready, how does the money come in? It takes one of the two highways, the automatic route or the government route. Standard technology sectors like SaaS or B2B e-commerce enjoy 100% FDI under the automatic route. But coming to the most important thing for us, for our due diligence as CAs, which is absolutely critical, press note 3 of 2020. To protect our national security, India mandates that if an investor is from a country sharing land border with us, like China or Pakistan, then they cannot use the easy automatic route. They have to take the government route for security screening. But foreign friends are clever. A Chinese investor may route their money through a shell company in Singapore or Cayman Islands to make it look clean. As CAs, we cannot be fooled by this. We need to look past the immediate investor and find the ultimate beneficial owner. But just in case, if a land border investor is purely a silent financial partner owning less than or equal to 10% of the company with 0 board seats, then the startup can still use the automatic route. But if it crosses the 10% line or takes control, then it is headed straight back to the government portal. Now, how do we execute the transaction? There are 3 FDI compliance requirements which need to be performed in perfect sequence before we utilize the funds. Firstly, the startup needs to have a dedicated bank account with an authorized dealer bank to legally receive foreign remittance. Second, to ensure that shares aren't issued below fair value, an arm's length valuation certificate needs to be issued by a chartered accountant or a SEBI registered merchant banker. And finally, only after verifying pricing and compliance can the board formally allot shares to the global investor. Bear in mind, the foreign investors enjoy hybrid instruments like convertible preference shares or convertible notes for early stage seed funding. A convertible note allows a startup to secure money immediately and delay the valuation conversation, provided they are DPIIT recognized, receive rupees 25 lakhs in a single tranche, and convert within 10 years. Now, does the strict tracing really matter in real life? Let's look at Paytm Payments Bank. This highly regulated RBI entity had a major indirect investor, a Chinese corporate giant named Ant Group. Because of this underlying Chinese beneficial ownership structure, it had to face intense foreign ownership scrutiny under FEMA and banking license conditions. The consequence? RBI issued a strict order against new customer onboarding. And by 2024, operations were frozen for months, dealing a massive blow to their valuation. This shows FDI scrutiny applies to regulated sectors even after investment is made. And if you don't check the UBO structure carefully at the front end, regulatory backlash can halt a billion-dollar business. Now, moving forward, we have to think about when the inward remittance hits the bank account, what actually happens? That's when a strict statutory countdown begins. You have exactly 60 days to formally allot shares to the investor. If you fail to do so, you have to send the money back within 15 days. And within 30 days of that allotment, we must file Form FCGPR in the RBI's FIR-MS portal. We can file FCTRS for secondary transfer of existing shares between an Indian resident and a non-resident. We have the CN report for convertible notes. And also, finally, the FLA, Foreign Liabilities and Assets Return, to be filed by July 15th every single year. Now, as articles, we may think, oh, it's just a form. If we file it within a few days, then we may just have to pay a tiny late fee. Well, let's look at Byju's. During their rapid fundraising season, they missed the strict 30-day window to file Form FCGPR across multiple rounds. The result? They had to undergo formal compounding proceedings with RBI and paid a massive rupees 1.6 crore penalty just for a reporting delay. The message is loud and clear. FCGPR is not optional, and the 30-day window is dead strict. If a FEMA violation is quantifiable, then the penalty can skyrocket up to 3 times the transacted amount. But if not, a flat penalty of rupees 2 lakhs and rupees 5,000 for every single day it goes uncorrected. But more than the cash, the RBI can freeze bank accounts, can halt future funding rounds, and completely ruin a company's momentum. But let's look at the flip side. What happens when an Indian startup completely treats compliance as a strategic asset from day one? Let's look at the incredible success story of Ola Electric. They leveraged their DPIIT certification to fund engineering, and their rock-solid regulatory compliance was made global giants like SoftBank and Tiger Global confidently inject almost $3.8 billion across 8 instance rounds. The ultimate reward? In 2024, Ola Electric launched the India's biggest IPO on the NSE and BSE, raising rupees 6,145 crore. Now that shows that flawless tracking helps an institutional trust to go from a garage startup to a publicly listed legacy company. Moving forward, the future of global capital boils down to 4 game-changing pillars. Gift City as a global hub. The IFSC in Gandhinagar is India's answer to Singapore, offering foreign investors with zero capital gains tax, no dividend tax, and USD-denominated investments on Indian soil. Abolition of the angel tax. It stands as the single biggest startup tax reform in a decade, clearing the runway for premium valuations. Emerging opportunities for CAs. This regulatory compliance is now a goldmine for our profession in FDI advisory and FEMA compliance. Because startups don't just need us to audit past books. They want us to be forward-looking strategic advisors, designing clean cap tables, performing deep UBO due diligence, and maintaining ADA bank relationships. We are the strategic gatekeepers of the global capital. And finally, we are deploying our world-class digital infrastructure globally, allowing international investors to complete digital KYCs and invest from anywhere on the planet. To wrap things up, the operational reality of our ecosystem is clear. Regulatory compliance and corporate growth are deeply intertwined. The role of a chartered accountant has evolved. We as CAs do something incredible. We protect the startup's dream. We shield the director from personal liability, protect corporate assets, and also build a flawless legal foundation for the Indian startups to conquer the global stage. UDGAM is all about rising. And with these future-ready compliance frameworks, our startups will do exactly that. I would like to thank CA Vikram Jude Saldana and CA Salome Lobo for their constant support, and my friend Rachel and Vihal for the PPT and their constant guidance, and to the entire team of DLS & Co. Thank you so much, everyone.
Kindly note, the time taken by Austin Johann is 10 minutes and 22 seconds.
Thank you, Austin, for the excellent presentation. Let us give all our presenters a huge round of applause for their commendable efforts and valuable contributions. Constructive guidance and feedback remain essential in refining perspectives and deepening our understanding. Having witnessed a series of thought-provoking presentations, we now look forward to the valuable observations of our esteemed session chairperson. I request CA Swathi Pai to kindly offer her valuable insights on the presentations delivered today.
Hello, everyone. Good morning. First of all, I would like to take this opportunity to thank SICASA Mangaluru team as well as the managing committee for organizing this conference. And also to all the students present here for choosing to spend your time engaging with ideas that are complex, evolving, and quite exciting. What a wonderful set of presentation we have had today. Each one of you, Madhav, Abhijeet, Anisha, and Austin, you have done a thorough research, clearly delivered and collectively presented a picture of the most important financial ecosystem of our generation, the startup world. Madhav, your presentation highlighted that this valuation is a negotiated story and not just a mathematical certainty. That is very commendable. And Abhijeet, your session on SME IPO is a masterclass on compliance. You made a very dry topic quite interesting. And Anisha, your clarity on how accounting treatment works is quite appreciated. The rule fixed for fixed test is something that explains your nuanced thinking. Then Austin, you had a very good start. You made so many relatable examples taking up real-world startups. So excellent job. Overall, congratulations to each one of the presenters. You have made this session a great one. So having said that, now I would like to add upon few things what I have observed. So if I have to sum up today's session in one sentence, it would be, startup is not just a business, it is a financial architecture, and we as CAs are its architects. All the 4 topics today are not different stories. Rather, they are different chapters of the same story. The story, startup ecosystem and capital market, which begins with a simple idea and one question: where will the money come from? Our topic on modern financing option quite answered it for us. Once the money comes in, the immediate next question is what happens to the ownership? What about risk and reward? What about incentives? The topic valuation, ESOP and CCPS answered it for us. Then, once the startup grows, the next question is how do we tap into global capital while being locally compliant? Our topic on FEMA, DPIIT recognition and FDI compliance answered it for us. Then comes the one big question for every startup. How do we go public? The answer to this is SME IPO. Now, let us understand how this works in the real world. Let us take an example that is very popular among the Gen Zs, or rather should I say, a startup that was founded in 2021 by Gen Zs, by 2 19-year-old teenagers. The startup, which was the beginning of 10-minute grocery delivery. You might have guessed it right by now. I'm going to talk about Zepto. So in the initial days of Zepto, it was heavily funded by foreign investors, and including Y Combinator, Nexus, later on Stepstone, and they have raised about more than $2 billion US. So each of this round required CCPS documentation, FEMA compliances, and a valuation report by a chartered accountant. Anisha rightly mentioned that debt today, equity tomorrow was at the essence of every check that Zepto delivered at the initial stage. Currently, Zepto is valued at about $7 billion US, and it has a huge ESOP pool. In the year, very recently, Zepto has also made a ESOP buyback that is quite one of the largest in its sector. The point that Madhav brought up, that at the crossover of Series C, there is a possibility that employee shareholding could be more than the founders, was playing rightly for Zepto. All these ESOP compliances again requires a chartered accountant to be on board. Like I mentioned in the first point, Zepto was heavily funded by foreign investors, which exposed it to all these FEMA compliances, FCGPR, as well as FLA returns. Not just that, Zepto initially was structurally based out of Singapore. Then in the year 2024, they have redomiciled back to India, which required complex approvals from FEMA, and many other changes in the shareholder agreement cap table, which was navigated by a team of chartered accountants along with legal professionals. Now, Zepto currently is at a stage where it has one big question in front of it. Will it ever go public? And all the early signals tell us yes. Because of the scale and extent at which Zepto operates, it will be a mainstream listing. But the procedural aspects, what Abhijeet highlighted in his session, holds good. Be it the CCPS conversion, restatement of the balance sheet, disclosure of related party transactions, all this exactly holds good. So, throughout the life cycle of Zepto, all the 4 topics that we had today was discussed. And this is exactly how it works out in the real world. India today has approximately 1.4 DPIIT recognized startups and about 4 lakhs chartered accountant. Simple math tells us that there is enough supply, isn't it? But what is the right question is about is the supply actually enough? And it is answered by the quality of the demand. If a startup requires chartered accountant who can file their written or sign an audit report, they can easily find one. But what is the requirement in the current day is a CA who can understand term sheets, who can understand valuation, who can explain them what an anti-dilution clause means. And most importantly, to be a support to the promoter or the founder to help them understand what exactly happens to the capital from the day of inception till they go into listing. This is the role of a chartered accountant in the startup world. The session today has definitely given you a building block. Now it depends upon you how you build upon it. There is a saying that accounting is the language of business. Today I would like to tweak it a bit and make it accounting is the language of business, and in the startup world, CA is its translator. So over the period of a startup's life cycle, it will come across founders. Founders will come across investors, regulators, bankers, or even the stock exchange. And throughout this, they will need a chartered accountant with them. Not because the law requires one, but because the decisions are so consequential if they go wrong. Over a period of time, I've spoken to multiple startup founders, and what I've realized is they are well equipped with product design, innovation, product market fit, business model, and even company's vision. But what they're not fluent at is understanding valuation, understanding the FEMA compliance, SEBI regulations, and all these regulatory aspects. And this is exactly the point of intersection where a chartered accountant comes on board as a partner in growth. And in fact, that is what Vriddhi means, growth, and precisely the essence of today's session. Thank you everyone for being such patient listeners. Enjoy the rest of the day.
Thank you very much, ma'am. Your valuable observations and guidance have greatly enriched the session. I now invite CM Mamta Rao, Vice Chairperson of the Mangaluru branch of SIRC of ICAI, to present the token of gratitude to our moderator and the paper presenters in acknowledgement of the invaluable contribution and enriching presents that have added value to the session. Thank you, ma'am.